Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know First Hugging Face's co-founder claims current AI can't achieve Nobel-level breakthroughs, challenging Silicon Valley's core innovation narrative. We'll explore how this next word prediction flaw could transform AI research and development roadmaps. Second, Microsoft CTO declares a pivot to custom AI chips a direct challenge to Nvidia's market dominance amid a massive compute crunch. So we'll discuss why this full stack strategy matters and what it means for Nvidia's CUDA ecosystem and the broader chip market. Third, Robinhood CEO predicts unstoppable asset tokenization will disrupt global finance, with Europe outpacing a resistant United States. We'll analyze why this trend is a turning point and how it could affect competitive dynamics between traditional finance and blockchain platforms. Fourth, OpenAI's $500 billion Stargate project partners with rivals Samsung and SK Hynix, escalating the global war for high bandwidth memory chips. This discussion will reveal how this partnership connects to the larger trend of sovereign AI and what it means for the future of the semiconductor supply chain. Fifth, Elon Musk's net worth shatters the $500 billion barrier fueled by investor bets on Tesla's AI and robotics future. In this episode, we'll break down the Musk premium and the potential $1 trillion pay package and what it signals for corporate governance and high-risk innovation. A top AI founder just dropped a bombshell, pouring cold water on the entire industry's biggest promise. Thomas Wolfe, the co-founder of the $4.5 billion AI startup Hugging Face, is going on the record. He says today's AI models, including those from giants like OpenAI, are unlikely to produce Nobel Prize-level scientific breakthroughs. So what's the problem? Wolfe points to a fundamental flaw. He explains that chatbots like ChatGPT are designed to do two things: agree with the user and predict the most likely next word in a sentence. They are built to be predictable. You see, this next word prediction is the very foundation of how large language models, or LLMs, work. They've analyzed trillions of words from the internet and books, and they've learnt the statistical probability of which word should follow another. It's why they are so fluent and sound so human. But they are essentially masters of the average, the expected, the conventional. They are designed to give you the most plausible sounding answer, not the most creative or revolutionary one. But that's the exact opposite of how great minds work. Wolfe notes that scientists who make major breakthroughs are contrarian. They question everything. In his own words, the scientist is not trying to predict the most likely next word. He's trying to predict this very novel thing that's actually surprisingly unlikely, but actually is true. And this is where the cutting edge of AI research is headed. To solve this exact problem, some startups and research labs are trying to build what you might call contrarian AI. Instead of just predicting words, they're using architectures like causal inference. In essence, they're attempting to build AI that can actually grasp cause and effect. One study, for example, fed an AI over 43,000 psychology articles to build a causal graph, a map of what causes what. The AI then used this map to generate over 100 new testable hypotheses, moving beyond just repeating what it's already read. This view is in stark contrast to other AI leaders. For example, Anthropic CEO Dario Amodei recently predicted that AI will allow us to compress 50 to 100 years of biological progress into the next 5 to 10 years. Wolfe says with the current crop of models, that's just not possible. He sees today's AI not as the scientist, but as a co-pilot for a scientist, a powerful research assistant to help a human generate ideas, much like Google DeepMind's AlphaFold helps analyze protein structures. Now, this co-pilot role is still a massive deal, but it also shines a light on the next major hurdle. AlphaFold could times predict times protein structures, but it couldn't actually run the experiments to verify them. The next frontier is connecting these AI brains to robotic platforms to create fully autonomous self-driving labs. Imagine an AI that not only devises a hypothesis, but then operates robotic arms to mix chemicals, run tests, and learn from the physical results 24/7. This is so much harder than just building the model because the real world is messy and unpredictable, and it requires an entirely new level of integration between AI software and robotic hardware. And it all comes down to a central paradox. The very thing that makes AI so good at sounding human, its ability to predict the most probable and agreeable answer, is exactly what Wolf argues will prevent it from ever achieving the improbable, paradigm-shifting breakthroughs that define true genius. This paradox in turn creates one of the biggest challenges in AI safety. If we succeed in building a truly contrarian AI that questions established facts, how do we stop it from generating sophisticated, plausible-sounding scientific times, misinformation, asterisk? How do you program an AI to tell the difference between a revolutionary idea like Copernicus suggesting the Earth orbits the sun and a complex, data-backed flat Earth theory? This is called the epistemic safety challenge, and it's a profound problem. We want an AI that can think outside the box, but we have to be sure it doesn't just build a more convincing but completely wrong box. We were just talking about the very soul of AI, the models themselves. Now, let's pivot to the body, the silicon that brings it all to life. Microsoft's chief technology officer just went on the record with a bombshell statement about its AI future. When asked if the long-term plan is to use mainly Microsoft's own chips in its data centers, his answer was one word: absolutely. A while back, we broke down Nvidia's surprise tie-up with Intel to diversify its manufacturing risk. Today's twist is even more direct. Microsoft wants to cut reliance altogether by leaning on its own silicon. This is a direct challenge to Nvidia, the undisputed king of AI chips. For years, Microsoft has been a top customer, admitting that Nvidia provided the best price performance solution for years and years. But that era is ending. Microsoft is now building its own custom silicon, like the Azure Maya AI accelerator, signaling a dramatic pivot from partner to competitor. And remember, we talked about Microsoft scooping up hundreds of thousands of NVIDIA's new Blackwell GB200s. That near-term buying spree can coexist with a longer-term plan to become a competitor. The economics behind this move are frankly staggering. NVIDIA's top-tier AI chips, the H100s, can cost anywhere from $25,000 to $40,000 per chip. When you're buying them by the tens of thousands, that cost becomes astronomical. The reality is, once you reach a certain scale, it can become vastly cheaper to design your own custom silicon. To give you an idea of the savings, some analysts estimate that Google, by making its own custom chips, runs its AI workloads at about 20% of the cost of companies buying from Nvidia. That's a massive cost advantage, and Microsoft is chasing that same prize. We previously noted how scarcity handed Nvidia outsized pricing power. Custom chips are Microsoft's shot at flipping that equation. And the reason for this shift is a problem of staggering scale. According to Microsoft's CTO, the current shortage of computing power is so extreme that calling it a massive crunch is probably an understatement. The demand is so intense that tech giants like Microsoft, Google, and Amazon have committed to spending over $300 billion on capital expenditures this year, much of it dedicated to AI infrastructure. We also flagged how Microsoft has been forced to rent capacity in Europe, deals worth up to $19.4 billion, and commit a $15.5 billion UK build out just to keep pace. That's what a crunch looks like. However, if you zoom out, you'll see another layer of strategy at play. This isn't just about swapping out one chip for another. The company's strategy is to design the entire system from the ground up, the servers, the networks, and even new microfluidic cooling technologies to prevent overheating. Continuing our last discussion about the hidden costs, electricity and even water, this is where those new cooling ideas matter, especially as mega sites like the Wisconsin project run into power and water constraints. The significance of this full stack approach is that it's a direct assault on NVIDIA's biggest advantage. For years, NVIDIA hasn't just sold chips. It has sold an entire ecosystem built around its software called CUDA. Think of CUDA as the operating system for AI. It's what makes the chips run, and it's so dominant that it creates a powerful vendor lock-in. By building everything from the chip to the cooling system themselves, Microsoft isn't just trying to save money, they're trying to break free from NVIDIA's golden cage and create their own. Meanwhile, NVIDIA is widening its moat by pairing its GPU designs with Intel's factories while keeping its crown jewels at TSMC. So Microsoft's counter is to build a rival moat by owning more of the stack. The real endgame is total control and self-sufficiency in the global race for AI dominance. This all comes down to one core reality. The AI boom has created demand so insatiable that, as Microsoft's CTO warned, Even their most ambitious forecasts are just turning out to be insufficient on a regular basis. In this new arms race, the biggest players in tech have decided that to win, they can no longer rely on anyone but themselves. And as Nvidia itself has said, demand will outstrip supply well into next year. So Microsoft's warning fits the broader pattern we've been tracking. So what does this mean for everyone else? If the biggest tech giants are all building their own custom, hyper-optimized chips and prioritizing their own internal workloads, what about the startups, the university researchers, and the smaller companies? The big fear is that this could create a permanent compute divide, a world of AI haves and have-nots, leaving everyone else scrambling for more expensive, less powerful hardware and potentially stifling the very innovation that fuels this industry. We've already seen how giants cornering GB200 squeeze startups and universities. If Microsoft succeeds in going vertical, the divide could harden unless capacity truly expands. Speaking of disrupting established ecosystems, a similar battle is brewing in the world of finance, where a new technology is on a collision course with the old guard. The CEO of Robinhood just went on the record with a prediction so bold it could redefine the entire global economy. His exact words, "Tokenization is like a freight train. It can't be stopped, and eventually it's going to eat the entire financial system." This is the concept of turning real-world assets from stocks and bonds to real estate into digital tokens that can be recorded and traded on a blockchain. And this isn't just talk. Robinhood recently began offering over 200 tokenized US stocks to customers in the European Union, a move that sent its own stock surging to a record high. Now, you might be thinking this is just like fractional shares, but the distinction is crucial. A fractional share is just a slice of ownership recorded in a company's private ledger. But a tokenized stock is a digital bearer asset that lives on a public blockchain, in this case, a network called Arbitrum. The key is that this allows for things that are impossible today, like 24/7 trading. The market doesn't have to close. The tokens themselves are fully backed by real shares, so you still get dividends. The one catch, for now, token holders don't get voting rights, but it's a fundamentally new and more efficient way to own a piece of an asset. According to CEO Vlad Tenev, this will become the default way to get exposure to US stocks outside the United States. He predicts most major markets will have a framework for this within the next 5 years. This is where the situation takes a more complex turn. While Europe is expected to lead the charge, Tenev predicts the United States will be among the last economies to fully tokenize. The reason? America's traditional financial infrastructure is so entrenched, it will be the slowest to change. And it's not just about old technology. The resistance is deeply entrenched, coming from powerful incumbents. The Depository Trust and Clearing Corporation, or DTCC, which is the central hub for almost all US stock trades, has openly expressed skepticism. They argue that moving to a blockchain system could actually be less efficient and would undo decades of risk management practices. This context is critical because at the same time, reports show that major Wall Street firms are actively lobbying to slow down crypto-friendly reforms to protect their existing business models and fees. And this isn't some fringe idea from a single company. Institutional giants like Morgan Stanley and BlackRock are also signaling interest, suggesting a massive systemic shift is already in motion. For example, BlackRock, the world's largest asset manager, has already launched its own tokenized fund called BUIDL on the Ethereum blockchain. It's essentially a fund holding US treasury bills, but you own it as a token. This shows the platform war to become the app store for real-world assets is already underway. Tenev says that for a long time, cryptocurrency and traditional finance have been living in two separate worlds. Now, he says they are going to fully merge. What this merger sets up is a collision of opportunities and entirely new kinds of risk. In a 24/7 tokenized world without traditional circuit breakers, what happens if a critical smart contract gets hacked? Or if a price oracle, the service that feeds real-world prices to the blockchain, is manipulated? We've already seen this in the crypto world, where attackers have manipulated prices to borrow huge sums against artificially inflated collateral. In a world with trillions of dollars in real-world assets built on this tech, a single vulnerability could be catastrophic, triggering a financial crisis at the speed of light. The walls between crypto and traditional finance aren't just cracking, they are being bulldozed into a single unified market. From a platform war in finance to a supply chain war in semiconductors, a seemingly impossible collaboration became a reality yesterday in South Korea. Get this. Two sworn enemies in the global chip war, South Korean giants Samsung and SK Hynix, just announced they're partnering with OpenAI. What's actually going on is a brilliant strategic play by OpenAI. By engaging both of these leading memory chip manufacturers, the company is creating a competitive dynamic. The goal is to secure a diversified and reliable supply of critical components, but also to drive down costs and accelerate technological advancements by pitting these two giants against each other. As we noted a while back, governments and platforms worry about concentration risk. If any single country or supplier dominates advanced AI memory, this move lines up with that playbook. The market reaction was immediate and explosive. SK Hynix stock surged nearly 10% to levels not seen since the year 2000, while Samsung shares hit their highest point since January 2021. The scale of this ambition is what's driving the market's reaction. A massive deal for OpenAI's Stargate initiative, a project designed to scale up production of the advanced memory chips that power next-generation AI. We said earlier Micron's rally was the counterpoint that this market isn't winner-take-all. Today's pop-in Seoul is the other shoe dropping. Stargate isn't just some project. It's a rumoured $500 billion investment in AI infrastructure. This deal aims to scale up chip production to a staggering 900,000 wafer starts per month. To put that in perspective, that is more than double the entire current industry capacity for these advanced chips. This move shows OpenAI is building its own global supply chain, diversifying beyond its primary partner, Microsoft. Remember our discussion of the Jevons paradox in AI hardware? As memory gets better and denser, overall compute demand accelerates. This scale is exactly that in action. But this isn't just about collaboration. What really brought this to a head was the high-stakes power struggle underneath. The core of this battle is for a single critical customer, the AI giant Nvidia. For years, SK Hynix has been Nvidia's main supplier for high bandwidth memory, or HBM, cementing its lead in the AI value chain. Meanwhile, Samsung, the traditional market leader in memory, has reportedly been working to get its own advanced chips certified by Nvidia. As we covered a while back, SK Hynix built an early lead by aligning tightly with Nvidia's roadmap and pushing toward HBM4 with hybrid bonding. This deal is a way for Samsung to close that gap. Interestingly enough, the entire AI race has been laser focused on GPUs, but this deal exposes the real bottleneck to memory. It's an issue known as the memory wall. Long-time listeners will remember we already broke down the 3D stacked skyscraper design of HBM, so I'll spare the deep dive. Just imagine a world-class chef who can cook faster than anyone, but their ingredients are delivered one by one through a tiny window. The chef is the GPU and the window is the memory. High bandwidth memory, or HBM, is like making that window much, much bigger, allowing massive amounts of data to flow to the AI models. Without it, the AI revolution grinds to a halt. This all points to a new model for building national AI power. This deal involved the South Korean president and government ministries, framing it as a national strategic effort. This is part of a global trend towards sovereign AI, where OpenAI provides the AI brain and partners with nations like South Korea to build the body, the physical infrastructure and data centers. We previously highlighted how the US is backing domestic HBM capacity through the CHIPS and Science Act support that help fuel Micron's expansion. Korea stepping in alongside OpenAI is another chapter in that same sovereignty playbook. And one statistic really puts Samsung's desperation into perspective. In its second quarter, profits from Samsung's chip business declined by an astounding 94% year on year. This partnership isn't a truce. It's a strategic realignment in the AI chip race, driven by one company's meteoric rise and a legacy giant's fight to reclaim its throne. As we've said before, it's a zero-sum game for IT budgets right now, and AI is winning. So moving aggressively toward HBM isn't optional for these players. It's survival. We were just talking about a $500 billion project to build AI's future. Well, believe it or not, one individual has just seen his personal net worth cross that very same number. A new record has just been shattered in the world of wealth. Elon Musk has become the first person in history to see their net worth cross $500 billion. This milestone isn't just about personal wealth. It signifies a concentration of economic power that rivals entire nation states. For instance, the combined net worth of the world's top 10 billionaires now exceeds the total GDP of 85 different nations. Musk's personal fortune alone surpasses the GDP of countries like Hungary. To put that in perspective, Musk's fortune briefly hit $500.1 billion. That leaves his nearest competitor, Oracle founder Larry Ellison, a staggering $150 billion behind. The situation presents a fascinating duality. This isn't just a rivalry over wealth, it's a clash of strategies in the great AI arms race. Musk is pursuing a vertically integrated approach, building the entire product from top to bottom with XAI and Tesla bots. Ellison, on the other hand, is playing the picks and shovels game, providing the foundational AI infrastructure through Oracle Cloud for other companies to use. A while back, we also broke down how I gained exclusive access to X's real-time conversational data after that merger, valued at about $33 billion down from the $44 billion Musk originally paid. That fire hose is a genuine training advantage, but it comes with ethical landmines if toxic behavior in the data bleeds into the models. This historic surge isn't just about one company. While Tesla's stock is up over 20% this year, the valuations for his other ventures, like the rocket company SpaceX and the artificial intelligence startup XA, have also been climbing. That edge in data helps explain why XAI's paper valuation keeps rising despite its youth. Behind those numbers is a phenomenon financial analysts call the Musk premium. The market isn't just valuing these companies on their current profits, it's betting on Musk's vision for the future. For example, a huge chunk of Tesla's valuation, over $470 billion, is attributed not to the cars it sells today, but to the promise of future ventures like humanoid robots and full self-driving technology. This is why Tesla's price-to-earnings ratio is so high. Investors are pricing in enormous future growth, creating a valuation that is heavily tied to the belief in one person's ability to deliver. And as we discussed before, XAI's exclusive pipeline from X amplifies that belief narrative useful for rapid model training, but risky from a safety and reputation standpoint. So what's fueling this massive run? Investors are reportedly welcoming Musk's renewed focus on his companies. According to the chair of Tesla's board, Musk is now front and center at the car maker, a shift that has been met with market enthusiasm. He even recently bought about $1 billion worth of Tesla shares, seen by many as a vote of confidence in the firm's future. But if you think $500 billion is the ceiling, the main course is just being served. Tesla's board has laid out a potential pay package for Musk that could be worth over $1 trillion. We mentioned a while back that shareholders were being asked to approve a package approaching $975 billion. Today's framing tips it over the trillion mark, but the underlying idea hasn't changed. To give you some context, this is completely unprecedented. The largest CEO pay packages in recent years, like the $161 million for Broadcom's CEO, are just a tiny fraction of this. Musk's previous record-breaking package from 2018 was valued at $2.3 billion. This kind of incentive structure raises huge corporate governance questions because it structurally forces the company to chase extremely high-risk, high-reward moonshots to generate the astronomical growth needed to pay it out, potentially at the expense of its core stable business. To unlock that, he'll need to hit a list of incredibly ambitious targets, including boosting Tesla's value eightfold, selling 1 million AI robots, and selling another 12 million Tesla cars. This is all happening as Tesla faces tough competition from rivals like China's BYD and attempts to transition into an AI and robotics business. But make no mistake, the pivot to AI and robotics is a monumental task. While Tesla's ambitions are huge, there's a real technological gap to close. For instance, in robotics, Boston Dynamics' Atlas robot currently shows far superior agility and mobility compared to Tesla's Optimus. And in autonomous driving, Waymo has logged millions of miles in fully autonomous mode without a human driver, while Tesla's full self-driving system is still in a beta phase that requires active driver supervision. This isn't just about being the world's richest person anymore. It's about a bet on future dominance in cars, AI, and space, with a potential $1 trillion prize on the line.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.